European stocks are raised gains after reports showed German manufacturing contracted more than Economist had estimated. Joining me down the line to discuss is Gerard Lyons from Standard Chartered Bank in London. So Gerard, the figures made for some disappointing reading as analysts had forecasted a rise of 48, but what were you expecting?
We were expecting the figures to be weak, and indeed the figures were weak, and they confirmed what has been an ongoing trend for some time, which is a sort of sluggish performance in the German manufacturing sector, and indeed in wider parts of the German economy. But maybe the thing about these figures is that they were maybe far weaker than even the most pessimistic expectations. So it's raised fears of a renewed downturn. That might be a bit premature, but I think the key message to take away is the data's in line and confirming other recent figures, which is that the German economy continues to cool.
According to German Finance Minister, business conditions across the manufacturing sector deteriorated further due to sharp and accelerated decrease in new orders. Could you pick out some of the biggest factors which have contributed to this slowdown in your opinion, please?
Yeah, there have been a combination of factors, but really this is a self-made problem in terms of Europe. Ineffective policy and a self-feeding downward spiral in the European economy has fed back into weakness in terms of the German economy itself. But on top of that, we have slower export growth from Germany to Asia. But having been out to Asia a few times in the last few months, what's interesting there is that one of the key contributing factors to the weaker performance in Asia itself has been both problems in Europe and worries about what could happen if Europe continued to implode. So what we really have here is a bizarre situation where the problems in Europe have directly hit Germany, but also the problems in Europe have fed into Asia, and in turn that has indirectly hit Germany as well through the export side. So bringing it all together, we have weaker German manufacturing exports to Asia. We have a pretty sluggish picture of demand in the periphery of Europe. Auto demand, for instance, is pretty weak. And on top of that, domestic confidence has taken a knock in Germany, so the weakness has spread from manufacturing towards services as well. So pretty much a weak picture.
What impact do you think this data will have on those investors thinking to buy German bonds?
A key message is that the European Central Bank is going to continue with its relatively aggressive monetary policy, which is to both keep interest rates low and to actually intervene in the bond markets on the periphery. In terms of the German bond market itself, it is relatively a safe haven, although it has to be said there was a slight upward tick in yields just at the latest auction. But that being said, bond yields in Germany are still low. One would expect that to remain the case, both as overall policy rates in Europe stay low, and there's still a sort of safe haven bias, shall we say, towards Germany. Of course, the wider picture is to sort of say that monetary policy in the West generally is very accommodative. There's ample liquidity. Investors are looking for a pickup in yield or looking for a safe haven in which to invest. But what we really need to see is a recovery in demand and in activity, and investors then looking to invest more, maybe into risky type assets. But for the moment, safety first, and that despite what's happened in latest developments in terms of markets' latest move, overall safety first, and German bonds still looking attractive.
Germany has been so far able to weather the economic storm, but these indicators is the most recent confirmation that the debt crisis is chipping away at German growth. However, their finance minister also said that they are on the right path and it would be a tragedy now to change direction. Do you agree with this?
Well, I think it's wrong to call it a debt crisis. This is a lack of growth crisis. The best way to actually get debts improved or to improve the debt dynamics is actually to have a return to economic growth. If you actually think debt is the only problem out there and then you have austerity as the only way to address debt problems, then you get yourself into almost a self-feeding downward spiral. So Germany is not immune to what's happening in the rest of Europe. What we really need to see is a sort of sensible assessment of the problems here. There's no doubt that in the good times, governments, some companies, but also many people spent too much. The big challenge is that if you try and address that in the bad times, difficult economic times, with austerity, then it's an incredibly painful process. There can be adjustment, as has been seen in Portugal and in Ireland, but there can be continued pain, as we're seeing in Greece, Italy and Spain. And coming back to Germany, what it really means is that Germany is not immune to what's going on elsewhere in Europe. Germany is not decoupled, but Germany certainly is better insulated because it's basically a much better placed economy. But really, Germany doesn't need austerity. No, Germany needs quite the opposite. It needs spending, it needs demand, and above all, it needs a return to confidence, hopefully sometime soon.
And finally, the factory sector have now contracted for 16 consecutive months. But what is your outlook for Europe's biggest economy moving forward?
The German economy remains sort of weak in terms of the growth figures. It's barely keeping its head above water. On the verge of recession might be the best way to think about it. When you think IFO surveys, which are now in negative territory, were sort of probably as high as 30 in February 2011, they were incredibly high levels compared to the negative territory they're in now. It highlights that since the beginning of 2011, there has been a significant deterioration in the overall economic climate, and that cooling has continued through this calendar year. I think, in answer to your question, the best way to say it is that the outcome depends on the interaction between the fundamentals, policy, and confidence. The fundamentals in the German economy are not too bad. It's pretty well placed, particularly as Asia is likely to grow as we move into next year. Policy is the challenge. Even though the European Central Bank is doing the right thing, the overall austerity elsewhere in Europe is having a feedback that's negative into the German economy. And then it comes down to confidence. Confidence clearly has been very fragile in recent months, still remains pretty weak. We need to see a turnaround in that. So the outcome is the interaction between the fundamentals, policy and confidence. Germany's barely keeping its head above water, just staying maybe out of negative territory, but only just.
Well, that's all we have time for at the moment, but there is plenty more coming up on Dukascopy TV throughout the week, so viewers, please do keep clicking back. But bye for now.